Welcome, everyone. We are so pleased to have you here with us for our 8th session of the day here at Gallagher Talks. During this session, our speakers will be discussing why the new normal has accelerated many trends that we are seeing in financial institutions. They'll talk about ever-changing risk profile for financial institutions, innovations from fintech, and why risk managers in every industry should be aware of these changes. I'm pleased to introduce to you today our speakers, Fayeanne Beattie, our Chief Financial Officer, and Mark Morency, our SVP Financial Institutions. If you would like more information on Fayeanne or Mark, please click to the right of your screen and you can connect with them there on LinkedIn. A couple of items before we get started. You'll be receiving a recording of this webinar later this week. And because of the fast-paced nature of our talks today, any questions sent in via the Q&A box from our clients and prospects, and anyone who's listening in today, will be addressed and responded to in several days from now. For anyone on the line having connectivity issues or sound issues, please reach out during the session using the Q&A box, and we will be here to reply and help troubleshoot with you. We hope you enjoy today's topic. Remember, if you're on LinkedIn or Twitter, please share along with your experience today using the hashtag Gallagher Talks. I also want to mention that we have a few more sessions taking place throughout the day, covering areas such as energy and captives. Just follow the link that will pop up on your screen following this presentation, and it will take you there. Without further delay, I will now turn it over to Fayeanne and Mark.
Thank you, Kelly. Here with Mark Morency, who is a Senior Vice President in our financial institution practice. And we're going to, have a really good conversation about fintechs. So how are you today, Mark?
I'm great, and I'm very excited that we have such a great topic to talk about this late in the afternoon. If anyone's attended all the sessions, I'm glad that we're the one just before a little bit of a break, so I'm glad we've got an exciting session to talk through.
That's great. Well, I'm looking forward to, talking and getting a bit of an understanding on what fintechs are in general, but also just looking for your views today, Mark, on a few different areas. So certainly, what's been changing in the fintech industry in financial services in Canada, as well as given the impact of the pandemic and how quickly that's transpired, what does this new normal look like in this space? And then also, now that we've, kind of entered into this new way of conducting business, which you're going to enlighten us on, it would be good for us to think about, what are some of the things we need to be considering as we've seen these new trends that have accelerated in financial institutions with all of the innovation. So it'll be good for us to think about the changing risk profile that we're operating in, both from ourselves as business owners or managers, as risk managers, or as consumers. So looking forward to hearing about all of that.
Great.
So to get started, Mark, I was just wondering, it might be just good to level set for our discussion today. When we talk about fintech in the financial services industry, what does that mean? How should we be kind of level setting that?
Yeah, and fintech is a pretty commonly used term now, but it's really financial institution technology. Just to give a definition, according to Investopedia, fintech is an industry encompassing all kinds of technology and financial services, from businesses to consumers. Fintech describes any company that provides financial services through software or other technology and includes anything from mobile payment apps to cryptocurrency. Now, you may not pay attention to how much or how quickly things have changed, but in fact, financial services are changing very quickly. They were before the pandemic, and interestingly enough, now even more so because of the pandemic. Technologies that are characterized as fintech, they fall under a broad spectrum, and all of these have had, what they've had in common, I guess, is that they had cheap access to capital, innovation was quick and readily happening in this space. And really, in fact, the change has been growing exponentially as the technology has actually made it easier to invent new technology.
So what would be some of the names that we would be most familiar with, either, that we would have been using ourselves or with our businesses?
Yeah, this is a great question. And so I'll give a little bit on the screen about the Fintech ecosystem. And there's really a variety of areas where Fintech comes in. And actually, Canadians use or interact with Fintech a lot more often than we think we do. The technology, has been changing our experience with financial institutions. And when I say our experience, I mean everybody, because financial institutions are so core to our economic existence, whether you're a company or personally within your household. We all rely on financial institutions. And this is why this is very important for us to understand what's happening in this space. So turning to the term, what Fintech really is, I guess in the US, it's actually a little bit, I'm going to use a US example. It's a little bit easier to understand what a Fintech is from US examples, and I'll explain why in a second. So for example, and I'm looking for the right, maybe I'll just flip forward one more, the payments and remittances systems. In the US, if I wanted to send you money, how do I go about doing it? Now, in the past, I'd give you a check or give you cash, but now because of the pandemic, we don't want to be handling these things. One of the most popular ways to send money now is either through Venmo or PayPal. And Venmo, and this is really, really taken off in the last few months. Venmo is an app on your phone. You can pay anybody. All you need to know is their email or their phone number. You can send as little as $1 to them. And you send them the money by setting up a Venmo account. Everyone can pay each other. No worry about touching cash. Very easy. They instantly receive the money. Now in Canada, the reason I wanted to use a US example is because in Canada, we have email money transfer. So you don't necessarily realize that this is a fintech that you're using. While all banks offer this, it's actually a service of Interac. Interac is effectively our big fintech. That's a Canadian payment system that was set up 35 years ago. It's owned by all the banks to facilitate payment through new technologies. And as technologies evolve over time, Interac has evolved. Now, by bringing new technologies into the banks, and often in the Canadian example, it looks like you're really only using the bank system, it's really a well-funded fintech company. I wouldn't mind now, if you give me a chance, just give you one more example. I also want to talk about contactless payments. And perhaps I should just move this slide forward a little bit, sorry. The adaptation towards contactless payments has been underway for years, but the pandemic has prompted us to reconsider whether the solutions we've been pursuing are really contactless enough. What I mean by that, chip cards, mobile technologies replace cash, and they remove a certain amount of contact in the system or in the store environment, but the context of reducing virus potential, viewed through today's lens, we're seeing a lot of the systems, even like Apple Pay, fall a little bit short of our needs. You can wave a card, use a device, but there's still had been either a device in the store that you had to touch or signing for transactions. So over the coming months and years, you're going to see truly contactless options that transmit payments through mobile methods, like using text, are going to gain a lot of traction and change the way the point of sale experience happens. Likewise, we're seeing technology to reduce touch at the ATM, similar type of texting systems or scanning of QR codes. And in fact, on July 30th, Venmo, who I just talked about earlier, they announced a partnership with CVS, which is a very large, basically the American version of a Shoppers Drug Mart type of drugstore, to allow Venmo contactless payments at the checkout counter. And is Fayeanne still there? We might have lost Fayeanne. Well, I'm going to hope that it wasn't me that we lost. Am I still here? Well, I tell you what, I'm going to move on. and talk a little bit about the landscape for fintech companies prior to the pandemic. And so, before COVID-19, financial services in Canada and globally were already changing significantly. The growth in non-bank or non-regulated financial services had already been accelerating. And this is Did you lose me there? Am I still speaking to everyone? Hello. Well, sorry about that, everyone. A little bit of technical problems. I am going to assume that you are all still hearing me. I did say it would be an exciting presentation. It's just exciting for the wrong reasons now. Anyway, on to this slide. The shadow banking, which is really driven by fintech, but it's often called, and this is banking outside of the banking system. You can see on the right hand of this slide, according to CNBC, and this was in April of 2019, so a year before the pandemic, shadow banking was now at that point a $52 trillion industry, 75% increase since the financial crisis had ended 10 years earlier. And these activities go across the broad range of financial services activities, from lending to households, lending to business, advisory services, and market making, starting with mortgages. So if you look at the chart on the left-hand side of the slide, this is from The Economist magazine at I believe it was the episode at the end of August this year. In 2007, almost 80% of mortgages were created by banks. And generally, you would think about getting your mortgage from a bank. Now, a decade later, for the United States, a large market, more than half were originated by non-banks. Some examples of this non-banks that are providing mortgages are Quicken Loan and Loan Depot, which is a loan broker in California. Both were early online lenders that had invested heavily in a slick website and a responsive call center. Quicken Loan, as talk about companies that are coming from a different area, completely was a technology company. They actually were the owners of dictionary.com and thesaurus.com. They recently had an IPO for their lending company, Rocket Mortgages, which, as I said, is the largest mortgage lender in the United States. So how do banks respond to this? The banks responded by competing with fintech, by engaging a fintech. They turned to a fintech for help, and about 170 US banks partnered with a company called Blend, a Silicon Valley startup that now process more than $2 billion of loans a day in order to compete, offering mortgages in 3 minutes without paperwork, outsourced lending to a fintech. And by the way, last year, Quicken Loans actually opened a tech center in Windsor, Ontario, to take advantage of the new technology boom in Canada. And this is their first foray into Canada, where they have said they're going to start lending. This, of course, applies to lending to companies. Mid-sized firms, there's much more availability of lending from fintechs, and much more of their lending is coming from fintechs. So for borrowers and investors, the emergence of these innovative new firms means more competition in the financial system. Mid-sized firms struggling to access bank loans can turn to a wealth of new private credit funds for funding. Hello, Tyler.
How are you? It's great to see you.
Good. Stepping in from a little bit of technical issues we're having.
That's quite all right. That's quite all right. So hopefully I'll be able to jump in and add to the conversation here. It sounds like there's a lot of change in the financial landscape for sure, and obviously the recent changes in our world have caused a lot of people to rethink the way they approach things. It sounds like consumer behaviors are also changing. Maybe you can dig a little bit more into that for us and shed some light there.
Yeah, and this is where it's so important with the with fintech, and it's actually fortunate for us maybe that so much was going on in fintech, because COVID-19 has greatly accelerated demand for new banking and payment technologies. Cloud technologies and artificial intelligence can help banks weather the changes that were brought by COVID-19 and distinguish their offerings in the long term. An example of that is Canada's first digital bank, EQ Bank. They used the scalability of the cloud to basically meet the surge in digital demand, and recently reached $3 billion worth of deposits. According to the World Economic Forum, and this is the number that I have on the screen now, a report on COVID was published in June by the World Economic Forum. Before the coronavirus, the 2020s were already being framed as the decade for digital bank transformation. But this shift, which also reflected a practical need by banks, they needed more efficient operations to compete, as well as increasing pressure on banks to boost their return on equity and decrease their cost-income ratios. Meanwhile, a sudden disruption in the industry increased competition from new entrants such as Google, Amazon, Facebook, and Apple. COVID-19, as I said, has accelerated these demand, and by changing consumer behavior, as you mentioned, pushed them to consider new tools and technologies. In March 2020, a survey found that 82% of customers were concerned about visiting their branch, as we were concerned about doing anything at that time. And 63% of those polled were now more willing to try digital applications. And this kind of shift is really a long-lasting shift. The past 3 months it's been really the past time goes by so quickly. It's been the past many months, have set in motion changes that are not going to be stopping or reversed even as the social distancing measures are relaxed. This is certainly true in financial services, where the lockdown brought about a watershed moment for the proliferation of fintech. This new graphic or new stat that I have on the right-hand side of the screen comes from a survey by Boston Consulting Group. They found that 24% of customers are planning to either use branches less or stop visiting branches altogether after the crisis. Millennial and Gen Z customers in particular have warmed up to digital channels during the crisis, with 44% of those participants aged 18 to 34 enrolling in online or mobile banking for the first time ever, which actually blows me away that I thought the younger people were the people who are using the internet. And finally, just a very quick statistic here on ATM usage rates. Obviously, ATMs, we don't really use cash much anymore. Don't know the last time you've used cash, but I certainly don't have much need for it. And I'd much rather use something that I don't have to touch, really. ATM usage rates have been the big casualty of the pandemic. And this is a recent stat that ATM usage rates are down 50%, while fintech apps saw a 72% increase in use.
There's definitely been a shift for sure in the banking systems and just technology in general inundating the finance world for sure. And I know you've been at the center of it with regards to insurance, whether it be with cryptocurrency or other forms of payment service providers. Maybe you can talk a little bit more about that and the transitions to digital banking and just the impact of that.
Yeah, the trend, and actually I'll flip to a new slide. The biggest obstacle to the shift to digital banking, this is actually a quote from Scotiabank, was the sheer size at which, the sheer speed at which the transition had to take place. The virus had been in the news since early January, but the swiftness of the lockdowns in early March took the banking industry by surprise. Banks across the US and Canada have been pushing for digital banking for years now, but suddenly it was the only real option for many consumers. And this is all according to a vice president of digital channels at Scotiabank. So this is not just me speaking about that. But customers that are using digital service for the first time during COVID are quite likely to continue to use them. And so, while customers are going to face multiple digital, online, and mobile options for their banking needs, as many banks around the world are leaning into digital options, it's going to be incumbent on the bank to maintain customer loyalty through their targeted offerings, because customers simply open accounts elsewhere. It's much easier. There's much less loyalty when it's on the internet. Keeping in mind before COVID-19, and this is really the big change because I think some of this change is not necessarily that visible to us. If you were already using online banking, it's kind of, well, okay, what's changed? But actually, before COVID-19, the banking industry did a great deal of talking about becoming digital, but less than 15% of organizations actually considered themselves digital transformation leaders. In fact, during the last recession, or the long recovery of the last 10 years since the last recession, very few organizations actually bit the bullet of really building a digital-ready bank. And then the coronavirus pandemic hit, and everything changed overnight. Organizations were forced not only to provide customers digital banking and options, but it meant all customers, and they had to provide digital options for their employees themselves. And, sorry, excuse me. Everything that could move online instantly moved online. So for the banks that weren't well prepared, new business opportunities were lost. And for the banks that, all the banks had to prepare. And why would a bank move backwards once the potential for digital transformation had been realized, right? The financial institutions used to require you to visit a branch to complete an account opening or a loan application. We've now proven that you don't actually have to go into the branch to do these things. So really, all these frictions in the digital system where you had to have one-on-one interaction with people, this is all changed. And now they're going to make them as seamless as the best digital first organizations.
Yeah, Mark. So it's thanks for all of that good insight. So it really sounds like, given that there's been so much change and the banks have moved so quickly, it sounds like the new normal is here to stay. So with this much amount of innovation and investment that they've made, the financial institutions have made, and the pace of change, what are some of the risks that we need to be thinking of, as risk managers, business owners, or operators? What should we be, mindful of now, given how quickly this happened and what, kind of a new way of changing processes so quickly?
Right. Yeah. And really looking at that and what we need to be mindful, even just goes back to the comment I just said about no longer visiting branches to go in and do a signature. Financial institutions, if they don't require us to go in for loan applications, and this change has been brought in so quickly, if we look at the dark side of this, of course, we have to be aware of fraud, money laundering, cybercrime. The virus is changing the ways that we operate, which also changes the way criminals seek to do things, to move illicit goods or funds across international borders, and how banks have to mitigate these risks. The increased push toward digitization, it comes with its own risks and results in some unintended consequences around IT security and fraud risks. This analysis that's on the screen now from Experian shows a rise in fraud rates with a 33% increase across all financial products in April, which was the first full month of lockdown when compared with the previous monthly average. The largest increase was in car and other asset finance applications, which saw a 181% rise, along with followed by savings accounts with a 28% rise in fraudulent applications, fraudulent credit card applications by 17%, and also unsecured loans went up. These figures are a warning that banks and other financial service providers need to be alert, but also for ourselves and for those who accept funds. Assuming the world does stay to a material extent online, then we can expect digital identity, know your client, fintech to be in much greater demand to facilitate the general digitization of financial services. For every problem, there's also a fintech solution. We've seen a material rise in soft fraud, customers making claims in relation to goods and services that were in fact delivered, and hard fraud. And the fundamental shift to online means that fraud prevention solutions, which offer a smooth customer journey, will be sought after as a commodity. And finally, one other thing to be aware of is the growing sense of worry that many of the quick fixes that have been introduced in the last few months still face an uphill battle being converted into structural solutions. And so there is a risk that this may not ultimately be maintained in a sound way.
Right. So given all of these new or increased risk areas, how should we be looking to protect our business now that we are operating in this new normal with, new processes and quick fixes?
So we, of course, those who are the users of financial services, which is everybody, we should be looking at our cyber security and cyber insurance policies, looking at crime coverage. Even with setting aside everything I've said about fintechs, economic downturns increase fraud risk anyway. Several studies have shown that fraud increases when there's economic hardship. Amongst other things, stalling economies cause a spike in internal embezzlement and other types of occupational fraud. With respect to the 2008-2009 financial crisis, there was a study by BDO showed that the amount of money lost through fraud jumped by 20%.
Wow.
Crime insurance, of course, is an important protection against both internal and external fraud. But given the potential for increasing fraudulent activity now and different type of activity than what we were doing, more than ever now, it's important to understand what benefits crime insurance can provide. It's worth noting that a standard crime policy covers many but not all forms of fraud. So looking at how the coronavirus has changed the nature of our banking activities, there's many standalone products that provide coverage where standard crime does not, such as plastic card insurance or asset-based lending insurance. Further, there's impacts on property policies, the digitization of assets through blockchain and the Internet of Things and payment systems. And finally, I want to mention know your client, as they say in financial services, KYC rules. Knowing who you're really dealing with and whether the customer is who they claim to be. This is something that's becoming more and more relevant of a concern for non-financial companies with online and automated payment systems. And even from a client retention perspective, letting aside the security issues, it's much more challenging to own that client relationship. Your brand name does lose some value when they aren't purchasing your product in your store, but rather online. And the banks have also lost some of that ownership of the client relationship when the payment is through a third-party fintech supplier.
Right. Great. Well, thanks a lot, Mark. I think between you and then Tyler helping out, we had one little technical glitch there, but we just rolled right through that. So that's okay. This very well-oiled machine. So, these changes that we've seen in the fintech and the financial service industry, very interesting. And I'd say it's probably one of the most innovative spaces in Canada right now. They've just had to transition so quickly and just, it's amazing to see how everyone has rose to the occasion on both sides through the financial institutions, but also consumer behavior and how quick they've been able to adapt and, really change their risk tolerance around how we interact and do business with one another. So it really is amazing what can happen. And you think about it, a financial institution that was, so traditional that, for them to be able to turn so quickly, it really is amazing. I doubt this will probably be case studies for years to come on this.
Right.
So, I think, it's been lovely, chatting about this. It's also really good to hear what we need to be thinking about from a risk perspective. So thank you for that. And certainly if there are, questions or concerns that some of our viewers may have had, or people who are listening in, I'm sure we'd be happy to address that through the Q&A session that Kelly mentioned. So that's great. We'll try and get responses back to people as necessary.
Well, thank you, Fayeanne. It was a pleasure speaking to you today, and also demonstrating what to do when things go wrong with technology.
Yes, well, technology certainly helped me get some speaking notes to, and he jumped right in, so that was great. So thanks again, and so I think that really concludes where we were going with our Gallagher talk going on in FinTech. And I hope everyone who has joined will certainly listen in on the next session, which is using surety products to improve your balance sheet. So thank you everyone for joining us.
Thank you.